Hello everyone. Is there a bubble in sovereign bonds? Think about this. When you look at the current environment of sovereign bonds, you will see that the vast majority of issuers in developed economies are issuing bonds at negative real or nominal yields. What that tells us is that central banks have been depressing yields to abnormal levels even in growth periods. But what's most important is to ask yourself the following question. Would you buy any of those bonds at the current yield if the central bank was not injecting liquidity consistently and constantly? If the answer is no, then what you need to ask yourself is at what yield would you start looking, for example, at peripheral European bonds? 2, 3, 4 times maybe the current yield? That is a bubble. So the problem is not just that central banks are depressing artificially yields. The problem is also the impact that it has on risky assets. By depressing the yield of sovereign bonds, which are supposed to be the safest assets out there, what the central bank is doing is at the same time making it more expensive, and by making it more expensive, making investors take a lot more risk in the market than what they probably look for. More importantly, the tool that quantitative easing and bond purchase tries to achieve, what that tool tries to achieve is for governments to undertake the structural reforms that they need. However, by artificially depressing yields, what ends up happening is that it becomes a perverse incentive by which governments go from using monetary policy as a tool to undertake structural reforms and buy some time to a tool to not make structural reforms. And then the central bank is trapped because even in growth and inflation periods, the central bank cannot normalize policy because it would create massive ripple effects in the financing of sovereign issuers. So the problem is that what looks like an optically attractive policy that is making governments finance themselves cheaper is actually disguising risk but not eliminating it, generating a lot more risk on the economy by taking massive levels of debt and leverage and exposure to risky assets from other investors, etc. But more importantly, what it does is that it's not used the way it should, is that governments are using monetary policy to increase imbalances, not to reduce them. And then it becomes a self-fulfilling prophecy. Governments force central banks to continue to have low rates and inject massive liquidity and repurchase their bonds. Then the governments increase their deficits and increase their spending, and the central bank cannot normalize even when there's inflation and growth. Therefore, what ends up happening is that the impact of monetary policy and the return of monetary policy is a diminishing one, creating more bubbles with lower positive impact on the real economy. Thank you very much.